Heaven forbid I were to buy the farm, kick the bucket, shake St. Peter's hand, whatever you want to call it, I better have some life insurance, or else my family would be financially devastated if I were to die prematurely.
Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. Today we're talking about the key differences between term life insurance and whole life insurance, and I'll be joined by Lee Michael Morrison. Lee is an independent advisor representative with Cornerstone Private Advisors in South Florida. He holds a bachelor's degree in education from Stetson University and a master's degree also in education from Bowling Green State University. Lee has been in the financial services industry for over 12 years, and his passion is teaching people about how to manage their money effectively. A fun fact about Lee is that he's a classically trained conductor and has conducted at New World School of the Arts in Miami. And now, without any further delay, here's my conversation with Lee Michael Morrison. Lee, thank you so much for coming on the show today and for agreeing to answer my questions about life insurance. I like to start with the most basic question of all. So, what is life insurance and why would I need to insure my life?
Well, thank you, Andrew. And it's a pleasure and honor to be your guest. In its most basic form, it's exactly how it sounds. Life insurance is an insurance policy that is paid should the insured person die while the policy is in force. While there are certain exclusions, such as suicide within the first 2 years or others, that's basically how it works. If I were to die when my policy is in force, my wife, who is my primary beneficiary, would receive what's called the death benefit.
So, do you feel that everyone needs to have life insurance or only certain people in certain circumstances?
Yeah, so a case could be made that all adults should have some life insurance, but more pragmatically, if someone else other than you relies on your ability to earn income, then you really need life insurance. If I was still a single guy, 20 something years old, with no kids or mortgage, my need for life insurance is negligible. However, fast forward to now. I'm in my early 40s. I am married. I have a daughter, and we have a mortgage. Heaven forbid I were to buy the farm, kick the bucket, shake St. Peter's hand, whatever you want to call it. I better have some life insurance, or else my family would be financially devastated if I were to die prematurely.
Earlier, you mentioned two terms that I wanted to touch on: death benefit and beneficiary. Can you explain what those two terms are in a life insurance policy?
Sure, I'd be glad to. I always thought the phrase death benefit was kind of an oxymoron, and it's a funny way to put it. But the death benefit is the amount of money that would be paid to the beneficiary or beneficiaries should the insured die while the policy is in force. So, who are the beneficiaries? Well, that's determined by the policy owner, who is most often the insured person. Most frequently, the beneficiaries are, for example, a spouse or a business partner or adult children or a trust. I highly recommend, this is just a tip, not listing a minor child as a beneficiary unless there's a very good reason to. It creates nightmare scenarios with the probate court. Instead, list an adult person who you trust to use the money for your child's benefit, or even better, seek out legal counsel and ask about setting up a revocable trust.
Awesome. So, what are the major factors that will determine how much a life insurance policy will cost?
That's a good question. So, there are five major factors. Number one, the face amount or the death benefit. How much insurance are you actually purchasing? Obviously, the more insurance you purchase, the more it's going to cost. Number two, length of term. How many years do you want the policy to cover you? The longer you want your insurance to last, the more it's going to be. Age. While we never know when we're going to die, we do know that as we grow older, we gradually get closer to that ultimate date. Therefore, insurance costs grow more expensive as we age. Number four, health condition. Someone who's in tip-top shape and is not on any medications will get a better rate than her neighbor who uses tobacco products and is on blood pressure meds. And lastly, the type of insurance. Premiums are quite different depending on which type of life insurance policy you choose. Level term, annual renewable term, whole life, universal life, variable life, or some variant of those.
Now, I want to get into those different types of life insurance that you just talked about. Two of the most common types of life insurance are term life insurance and whole life insurance. What would you say are the fundamental differences between those two types of life insurance?
Now, that is a very important question, Andrew. First, all insurance, whether it's auto, home, health, or life insurance, is term insurance. It's important to remember that because many insurance agents simply don't teach how insurance works, which is what sets me apart from my so called competitors. No matter the type of life insurance policy, you will be asked to pay a premium in exchange for the company ensuring that they will pay a death benefit should you die during the term of the policy. Now, term insurance is usually designed in blocks of years, such as a 10-year term, 20-year term, 30-year term, and even up to 35 or 40-year term. Often, the premium amount remains level or stays the same for the length of the term, and the face amount or the death benefit stays the same for the term. As an example, I have a $750,000 20-year term life on myself. I pay $68 a month. Now I'm 43, so this will last me until I'm 62 years old. Whole life insurance is a type of cash value life insurance, meaning that there is a savings or a cash component bundled with the insurance. In whole life, the cash grows with interest, usually between 2 and 4% net of fees and expenses, and many times isn't greater than your total payments into the policy for the first 10 to 12 years. As an example, let's say I had bought that same $750,000 policy as a whole life policy. I wouldn't be paying $68 a month. I'd be paying closer to $600 to $800 a month. And I'd have no net cash value for the first 2 or 3 years. It'd take me at least a decade to turn a profit, which the profit would be taxable. A percentage of the cash value is available to the policy owner while the insured is living. And should the policy owner access the cash, it is a loan against the policy. Now, borrowing money from a life insurance policy does come at a cost. That cost is usually somewhere between 6 to 8% interest payable to the insurance company. So those are the two types that you asked about.
If I purchased a cash value life insurance policy, like the whole life policy we just talked about, what's going to happen to the cash value when I die? Is it going to go to my beneficiary in addition to the death benefit?
Usually not, Andrew. Now think of it. In a cash value policy, you are actually paying for two things. That's what the insured believes. They're paying for a term life insurance face amount, and they're paying for some kind of a cash savings. Now, let's say that person kicks the bucket, heaven forbid. Most policies will pay either the greater of the face amount or the cash value, net of loans, not both. In universal life or variable universal life, or some flavor of those policies, the policy owner can elect a death benefit option B or option 2, which would be both the face amount and the cash value net of any loans. However, most people don't choose option 2 or option B because it's even more expensive. Now, think about this. If you went to Starbucks and you paid for a vanilla latte and a pumpkin spice latte, my wife loves those, and you were only given the vanilla latte and were told, have a nice day, that completes your order, what would you do? Well, if you're like me, you'd probably complain to the manager, where's my other latte? But in the vast majority of cash value policies, such as whole life, that's exactly what happens. You pay for two things, but you or your family only end up getting one.
And what about if I borrowed against the cash value of my policy? What would happen if I died without paying that loan back?
Again, an excellent question. If you were to have a whole life or some other kind of cash value policy, and if you were to borrow your own money, that loan would accrue interest, again, usually around 6 to 8%. Now, if you don't pay it back, the remaining cash value is decreased by the interest charges. Now, let's say you have $100,000 of cash value policy and you have 20,000 of cash in the policy. Let's say you borrowed 10,000 out of it to renovate your kitchen, and then, heaven forbid, you die of a stroke. You'd think that your family should get a little less than 110,000, which is your insurance plus what you've saved minus some loan and interest charges. No, sir. They would get a little less than 90,000, which is the insurance amount minus the loan with interest charges.
What are a few of the other types of life insurance policies that I should be aware of?
Yes, and there's a lot of names out there. So I'm going to break down term first. And just remember, all insurance is term insurance. They just have other bells and whistles added to them. So when most people refer to term life insurance, they usually mean level term insurance, which is a set block of years where the payment and the death benefit remain level. There's also decreasing term, which is actually the term component of a whole life policy, where the payment remains level, but the insurance amount actually decreases as you get older. Lastly, there's annual renewable term, meaning that the payments are going to increase as you age, where the death benefit remains the same. Getting into the cash value policies, whole life insurance is designed to last exactly that, your whole life. So it charges you a higher premium now in exchange for the policy not lapsing until you're 99 years old, instead of a set block of time. Again, there are variants in that, but that's the basic concept. Now, universal life, a universal policy has an annual renewable term, meaning that the actual cost of insurance increases each year, and a cash savings in a separate account that the insurance company invests and takes the risk on. Because the insurance cost increases each year, the amount of premium that you're sending in each year, less and less of that will go towards the cash savings, and more will go towards the cost of insurance as you age. Should you be sending in money and it not even cover the insurance cost eventually, then they will start draining your cash savings to pay for the insurance. Variable life insurance has a flexible death benefit, although there is a guaranteed minimum. It also uses part of the premium you're sending in to invest in what's called variable sub-accounts, which are basically clones of mutual funds available on the open market. The insurance component is also annual renewable term, which again increases each year as you age. I know this sounds like it's a little complicated, and believe me, it can be. I also feel complexity works in favor of the insurance companies and against the clients in many cases.
Which type of life insurance do you feel is the best fit for the average person, and why?
That's a good question, Andrew. And before I answer that, I want to be very clear. My opinion isn't based on anything but math and behavioral personal finance. I like to say it's not an opinion, it's math. For the vast majority of Americans, American families, and American businesses, level term life insurance is the best bang for your buck. Look, what's the purpose of life insurance? In case we die prior to accumulating significant wealth, our families are made whole financially. Why would I pay 10 times the cost of an insurance for a cash value policy only to have them keep the cash if I die, or not pay the insurance benefit if I cash out? There are far more effective ways to save and invest for the future, such as utilizing a 401k, IRA, Roth IRA, 457 deferred comp plan, or even under your mattress. Now, let me be clear again. I'm not recommending any of those vehicles, but I am urging your viewers and listeners to check out third-party resources who aren't insurance salespeople to see what they say, like Consumer Reports, Kiplinger's Personal Finance, Money Magazine, Smart Money Magazine, USA Today Money, Dave Ramsey, Susie Orman, Clark Howard, and many others. They all agree. Stick with term life insurance and do your savings and investing somewhere else. Don't use a life policy to save and invest money.
I've heard the argument that a cash value policy is great because it forces you to save money. What would you say to that?
Well, it sounds like you've talked to an agent who's probably trying to sell you one. That's exactly what they argue. A cash value policy is forced savings. Andrew, what are we? 8 years old here? What I'd like to say is, why don't you work with a licensed financial professional who has the mind and the heart of a teacher and coach, who's actually going to teach you and coach you to actually save and invest without being forced to in a life policy? Seriously, a good financial professional should have a burning desire to educate you on how money works, not force you to save in an insurance policy that has little to no chance of turning a profit for the first decade you own it.
You know, I've also heard if you get a cash value life insurance policy and keep it for 15 or 20 years, you may not need to pay any more premiums and the policy will still stay active. Is there any truth to that statement?
Yes, there is some truth to that statement. Now, depending how the policy works, you're essentially overfunding it or overpaying, and then someday in the future, your policy has enough cash in it to continue paying the premiums out of the cash account without you needing to be sending in more money. However, who's really earning the bulk of the return on that money while you're paying it to the insurance company? You guessed it, the insurance company, not you.
Is there ever a situation where cash value life insurance would be the right choice for someone?
That's a good question. And Andrew, as much as I believe, and the math says, again, it's not just a belief, it's the math, that buying term and investing elsewhere is the best choice for the vast majority of people. Yes, there are situations where a cash value policy might make sense. Very wealthy individuals who will be subject to the estate taxes when they and their spouse die might benefit from, for example, a second to die whole life policy. That way, the beneficiaries could use the life insurance proceeds to pay Uncle Sam. Right now, the estate tax threshold is set around 23 million for married couples and 11.5 million for singles. I suppose that there is a risk that the government will lower that threshold, but how much lower could they go? Even if they cut it in half, over 98% of folks will never be subject to the estate tax and therefore should avoid cash value policies. For the 2%, then fine. Talk to your CPA, financial advisor, an estate planning attorney, and formulate what you need.
Lee, once again, thank you so much for coming on the show today and for educating us all about life insurance. If anyone would like to contact you or even work with you in a professional capacity, what's the best way to get in touch?
Thank you, Andrew, and it's been a pleasure being here today. I really admire what you do on practical personal finance. It's very valuable. The best way to contact me is at my work email, which is L as in Lee Morrison, which is with 2 R's and 1 S, at cornerpa.com. That is by far the best way to contact me.
I want to thank my good friend Lee Michael Morrison for taking the time to answer my questions about life insurance. If you or someone you know is looking for a financial advisor in South Florida, I would highly recommend speaking with Lee. His contact information is down below if you're watching on YouTube and in the show notes if you're listening to the podcast. Do you have any other questions about life insurance? Or maybe you just want to stir up some healthy debate? Leave a comment down below. If you enjoyed this video, you may be interested in another one I created in which I discuss how much term life insurance is right for you. Click right here to watch. And to show your support for my channel, click right here to subscribe. As always, thanks for watching. I'm Andrew Scheer, and I'll see you next time.